Today we're going to be talking about the Dodd-Frank debate. Jack Schlacke is an expert on U.S. banking regulation, and we'll discuss the regulatory issues arising under U.S. banking law. First, he will go through a presentation, and then after, you will be able to ask questions. When you ask your questions, please state your name and the organization you're from. Also, Mr. Schlacke is not a representative of the U.S. government and therefore does not represent the views of the U.S. government. Thank you.
Okay, so like she said, my name is Jack Schlacke. I'm a lawyer at a law firm in town called Linklaters, LLP. It's actually an English law firm, but I obviously work in the New York office, given my accent. So this presentation, the goal of this presentation is just to cover a few main points. I don't want to over-present because that would be boring for you. But basically, I want to provide a brief overview of the sort of pre-Dodd-Frank world because I think that's sort of important to understand Dodd-Frank and what may be coming down the pike in the Trump administration. And then I'll talk about the Dodd-Frank and then sort of the Trump administration. The slide deck you have has a lot more detail than I'm probably, especially on these early slides, probably has more detail than I'm going to go into. And the reason is I just wanted to provide it more as a reference. I will talk about probably a little bit about each slide, but I'm not going to, there's probably more in those slides that I'm going to sort of discuss just because it's, I thought it would be useful background. One thing that's interesting about the way that the United States sort of regulates the financial sector is that we have a lot of regulators. The regulation of the financial sector is very diffuse in a way that it tends not to be in other countries. And, I say diffuse, which is probably a nice way of saying disorganized. There are, we just have a lot of regulators. We have a lot of regulators and different parts of, there's a chart later on, but, different parts of a banking organization or a financial institution will have different regulators, and they sometimes are at cross purposes, and it's an interesting sort of situation. So let's start out just a little bit on sort of this is the major financial legislation prior to Dodd-Frank, and as you can see, it goes back 150 years. There has always been a sort of it's sort of in American political life, there's always been sort of a resistance to concentrations of power, and specifically economic power. And that's why, that's in a lot of ways you can sort of read the history of American sort of political thought in the statutes, because you can see, financial regulation gradually became more and more centralized in the federal government. I won't go through the statutes, but the one thing I would say about this is a very very small sampling. There are a lot more statutes, but this is probably the highlights in terms of sort of U.S. financial regulation. So I'm just going to go through a couple of the regulators. The first one is the Federal Reserve Board. It's probably one of the most important regulators, especially for sort of large banking organizations, and the reason for that is that it has the broadest oversight in a lot of ways, whereas sort of the SEC or some of the other regulators will regulate, particular entities within a larger organization. The Fed really can see everything, So, Bank of America, the Fed looks at everything within Bank of America. It doesn't just look at the sort of deposit-taking bank or the securities business. It looks at everything, and that gives it sort of a broader oversight of the market and the greatest ability to sort of look at riskier behavior. And that sort of comes through the authority to regulate bank holding companies on a consolidated basis. So the Office of the Comptroller of the Currency is actually the oldest of the federal financial regulators. It's been around since 1863. It is the authority that can charter federal banks. And that is, that is sort of its primary role. Historically, the OCC has tended to sort of push the envelope in terms of, of the sort of three major banking agencies, has been the one that sort of tended to push the envelope in terms of, giving banks broader powers to engage in sort of non-core banking activities. That's sort of historically been the case. And that sort of juxtaposes against the FDIC, because the FDIC has historically sort of been the most conservative. And the sort of rationale for that, right, is that the FDIC is trying to protect the sort of deposit insurance fund, the fund that insures all sort of domestic deposits, whereas the OCC is competing with state regulators to charter new banks. So that's the sort of general explanation given for it. So into the FDIC. Okay, so the SEC, probably most of you have heard of the SEC. It's another sort of pretty high-profile regulator. One thing, it obviously regulates sort of securities broker-dealers and investment advisors. It sort of has broad authority to oversee the securities, markets and businesses in the United States. The one thing to keep in mind about the SEC is the sort of last bullet point. Probably the thing that it does most, the sort of the greatest single, use of its resources has to do with the offering of securities by issuers, and that sort of includes both securities companies and non-securities companies. So if you're thinking about GE and sort of big non-securities businesses are all, in a way, sort of regulated by the SEC. I mean, they're regulated just as to their sort of disclosures and whatnot, but that is a huge part of what the SEC does. And I mean, it's giving to note, it's a very, very large agency. The CFTC historically regulates the commodity futures market. Sort of prior to 2008, people didn't tend to pay a lot of attention to it because the commodity futures market tended to be a kind of sleepy kind of area. In the post Dodd-Frank world, it now has jurisdiction over a large portion of the derivatives market, so it sort of has become more involved. It's become sort of a higher profile agency. It's still a pretty small agency, interestingly enough, especially like when you compare it to the SEC. And a lot of times the SEC and the CFTC together are sort of thought of as the market regulators, whereas sometimes the banking regulators can be referred to as the prudential regulators because they look not just at sort of conduct issues, but sort of broader sort of systemic issues. Like I said, the U.S. has I didn't actually say that, sorry. The U.S. has a federal system. Federal law will generally sort of preempt state law to the contrary, but there are areas, even in financial regulation, where state law continues to be, to be either the primary regulatory sort of authority, or sort of the two regimes work side by side. For instance, state banks. Every state in the country has a banking law that allows them to charter banks. If most of the sort of large U.S. banks, their sort of deposit-taking institution is chartered by the OCC. It's a national bank. But for instance, both Goldman Sachs and State Street, for instance, both of their deposit-taking banks are actually chartered by the states in which they operate. For Goldman, that's New York. State Street, it's Massachusetts. Insurance companies, there is no federal insurance regulation, which is sort of interesting and, actually comes up in a lot of different areas because, once in a while there will be discussion about sort of selling insurance across state lines, but in order to do that, you really need a federal insurance regulator, and we don't have one. And then non-bank lenders, this is an area that's begun to grow, and another area that should probably be on the slide is sort of money transmitters. And like in the fintech space, there is sort of growing need to sort of have greater clarity on issues around who can make loans, who can transmit money, things like that. And right now, it's very much a state-by-state regime, and because of that, there's sort of it becomes a lot more difficult for fintech companies to sort of operate. Okay, so this is just sort of maybe a little bit of a silly point, but one thing to keep in mind, especially when you're talking about state regulation, is that the United States isn't one jurisdiction, it's actually 51 or so. I mean, there's the federal system, and obviously there are 50 states, and a lot of times, questions really are matters of state law, and you have to actually think about which states you're talking about. the U.S. Department of Justice and the state attorneys general, they're not regulators in the sort of traditional sense, but they have become increasingly important, especially, certainly after the sort of financial crisis, but even before then. If you think about like the Enron scandal and a lot of things like that, a lot of the reason that got as much heat as it did was because of the Department of Justice and actually probably more of the state attorneys general. So they are becoming a larger and larger player in terms of financial regulation. So getting back to my point that U.S. financial regulation is diffuse, this chart is obviously trying to make a point, but you can look at this chart and you can see where the different types of entities and who is regulating them. And so it's important, that the goal here is to sort of visually see how diffuse and again, disorganized this sort of U.S. system can be. One final point on the sort of history point, because I think I've probably gone longer on this than I should have, but is the idea of banking versus commerce. And this goes back to the sort of point about the history of sort of financial regulation. In the U.S., like I said, there's historically been a resistance to large concentrations of economic power. And so historically in the United States, banking and finance businesses and commerce, which is sort of non-financial businesses, have been separated. And that is important sort of in terms of background, but it's also very important in terms of understanding a lot of the regulation in the United States now. Because, there are limits on, for instance, Goldman Sachs can't open a hot dog stand in Battery Park. It can't do it. It would be illegal. So it's just sort of, and the reason for that is because of this division between banking and commerce. Okay. So the Dodd-Frank Act, again, this is going to be pretty high level. I think I picked out 5 different topics within it. Yeah, 5. That we'll sort of cover pretty quickly, and then we can get to your questions. The Volcker Rule is probably in a lot of ways, sort of the biggest, highest profile piece of the Dodd-Frank Act. It broadly prohibits banks from engaging in proprietary trading and sponsoring and investing in covered funds. And then it also has restrictions with respect to sort of certain transactions with covered funds. Obviously, this has been a significant sort of compliance burden and required a lot of rethinking of a lot of, especially large banks, business models, and it's had a very wide impact, and I know because a lot of my clients are non-U.S. banks, has had a broad impact even outside the United States. OTC derivatives reform, which ironically is sort of turning into one of the less controversial aspects of Dodd-Frank. This has sort of proceeded in many countries, and certainly in the EU and most large Asian markets as well. That the OTC derivatives reform sort of comes out of the G20 commitments from Pittsburgh, which I think were in 2009, but yeah, it would have been 2009. It is sort of, there are obviously differences between regimes, but the broad idea of central clearing of derivatives transactions, margin requirements, exchange trading has all that is similar across jurisdictions. This sort of catch-all category of enhanced prudential standards, and this is another area that has required some significant sort of tailoring of business models. And, I won't go into too much detail here, but basically the idea is that if you're a large banking organization and you have, a large asset book where, you pose a risk not just to sort of yourself and your investors and whatnot, but you pose a broader risk to sort of the financial markets and the financial infrastructure of the United States and world more broadly. This sort of follows on from the experience of Bear Stearns, right? The experience of Lehman Brothers. When Lehman Brothers sort of filed for bankruptcy, it caused a lot of repercussions beyond just Lehman Brothers that impacted the market significantly. Those are sort of some of the broad highlights of the enhanced prudential standards rules. The Consumer Financial Protection Bureau was a new agency created by the Dodd-Frank Act. It is. It's been controversial, but in large part, it has sort of shifted a lot of the sort of consumer protection aspects of financial regulation away from the banking agencies and to this one bureau. So that has, the result of that, right, is that you have, rather than having the FDIC and the OCC and the Fed potentially examining you, you now have just the CFPB, which is sort of focusing on this, which is, depending on who you ask, a blessing or a curse. And finally, the Financial Stability Oversight Council, which is, it's not really an agency, but it's sort of a council of the heads of regulatory agencies that is charged with overseeing the financial system and trying to identify and head off financial risk in the system before it becomes as problematic as it sort of became in 2008. Okay, so final bit, reforming financial reform. And the way that this sort of started was shortly after he was inaugurated, President Trump directed the Treasury Secretary to review existing sort of U.S. financial laws, regulations, and produce a report. In June, the Treasury Department released its first report, which is just about depository institution holding companies. This is more about the Treasury report. This sort of contains the first draft, at least, of the administration's sort of regulatory agenda. The other point I wanted to make, and this is especially true sort of in the current context where, I think that there are areas in financial reform where there is sort of bipartisan consensus, and we could see some significant legislation. I think that there are a lot of areas within financial reform where that's just not going to happen. And I think that, and that's something, in light of that, I think that one thing that to keep in mind is that the people that the administration sort of puts into place are very important, because they're the ones that are sort of going to be interpreting these statutes and, developing new regulations and developing new guidance. And, these are the sort of major nominees. I know Keith because I once had a phone call with him, but other than that, I really don't know these guys. But, I have, his nominees to sort of major financial regulators have been pretty sort of within the 40-yard lines in terms of none of them are sort of considered ideologues. They're all considered sort of, people with industry experience who, understand the mission of the agencies that they're sort of charged with heading. So that's important. And it'll be interesting to see sort of, and they might have a different sort of perspective, but they, that's, and one of the reasons too, from my perspective, I don't view it as particularly likely that we're going to see groundbreaking changes to a lot of the sort of regulations. Okay, so concluding thoughts. This is a map of where my firm's offices are, and here's context for myself and Melissa. One thing they did sort of ask me to sort of talk about a little bit is sort of things that I would recommend to the administration in terms of priorities and things that sort of could get fixed and what have you. And to my mind, the sort of most important bit, and it's talked about a little bit in the Treasury report, is there is a need to increase lending to small and medium enterprises. If you look at the sort of lending market right now, there is a ton of credit available for the top, right? If you're a large business with a good credit rating, even if you don't have a great credit rating, there's a lot of credit out there for you. If you're a smaller or medium-sized enterprise, it's much, much different. One interesting point is there have been surveys that have showed that small businesses really haven't they do actually feel that their sort of credit needs are being met, but in terms of volume, the volume of loans to small and medium enterprises is way off. Really, really a great deal lower than it was, in the sort of mid-2000s. So, I think that there are a couple of ways to sort of get there. I think that that's, to my mind, that of all the areas of financial reform, I think that that's probably what I would view as the most important, because that's going to sort of feed into the real economy and sort of help grow the economy faster than some other things will. I think that, this is actually in the Treasury report as well. One of the things is I think that there is room to sort of rethink the sort of threshold for being considered systemically important under Dodd-Frank. The current threshold is $50 billion. If you have $50 billion in assets or more, you're considered systemically important. If you look at the sort of breakdown of U.S. banks, there's sort of three categories. There's the really, really big banks, the Goldman Sachs and the Bank of Americas and the J.P. Morgans. There are what we sort of term the community banks, which are small. And there are quite literally thousands of them. Small banks that, might have assets in the $100 or $200 million range that, serve a geographically sort of limited area and don't engage in sort of too many sophisticated sort of financial activities. They're not trading derivatives and they're not, they don't have a securities business. And then in the middle, there's what we call the regional banks, and there are a dozen or so of them, and they, a lot of them are over the $50 billion limit, but, I think there's a very strong argument to be made the fact that they don't pose the same risk to the financial system that, a Goldman Sachs or a Bank of America might. On the other hand, they are also much more likely to be sources of funding, of credit to the sort of middle market, certainly, and to a lesser extent to the sort of small business market as well. And I think that, there is, so that's why where I sort of come from when I say it makes sense to sort of raise the threshold for systemic importance, because then some of these enhanced prudential standards may in fact, may not be necessary for the sort of regional banks that I'm referring to. And I think there's a couple other things. You could recalibrate some of the capital requirements for the community and regional banks, just because, again, a lot of times small and medium size loans to small and medium sized enterprises, they really do have they have very significant capital charges. Capital charges that are higher than a loan to a large corporation would be, just because it's they are risky. To be fair, they are riskier, right? But at the same time, the difficulty with that approach is that it just makes it much more expensive for the banks to sort of hold that loan on its books or make the loan or originate the loan to begin with. Let's see, what else? I do a fair amount of work with Volcker, so I have some views on that. At this point, I think one of the interesting things from my perspective is that, I can remember after the election, people were just saying, Dodd-Frank's gone, the Volcker rule's going away. And I didn't really believe that at the time, and at this point I'm about 99.9% sure that the Volcker rule is probably going to be here to stay. There are some tweaks that I think could be made. A lot of what I actually think are the real concerns have to do with just sort of a lack of clarity in a lot of the regulations and the guidance, and particularly around sort of there's an exception to the Volcker rule known as the prop trading prohibition, known as the market making exception, and it has directly impacted a lot of market liquidity, especially in sort of traditionally illiquid instruments. And I think that the agencies, when they came out with the implementing regulations, they tried to sort of tailor it and sort of make it clear how it would apply to illiquid instruments, whether they're sort of corporate bonds or sort of derivative instruments, things like that. They haven't. They tried. It wasn't enough because I can say from experience that there is a significant amount of confusion about how that exception applies, and I actually think that probably what they should do is develop a sort of separate exception entirely just for sort of illiquid instruments, and they can still call it the market making exception. It would make sense to me to make it clearer to banking entities that they really can still make markets and sort of act as a dealer in these markets, because you don't want if an issuer's bonds are illiquid, they're going to be more expensive for the issuer to issue, and therefore it's going to be harder for them to raise money. Let's see, I'm trying to pick out the highlights here. There are a couple of things in the Treasury report that I thought were a little curious. I mean, one thing is that the Treasury report emphasizes in a couple of places about the need for sort of tailoring, and there's sort of two ways you can tailor, right? You can do something where you increase the sort of threshold. So you increase the systemic importance threshold from $50 billion to $250 billion. That's kind of tailoring, right? I mean, you just move the line, and maybe you sort of made a policy decision that 250 is better, but you haven't exactly tailored things. The difficulty with sort of real tailoring, where you sort of say you examine banks individually or financial institutions individually, and you say, okay, here's your business, and here are the risks it raises, and here's the things we're going to look at, and here are the rules that apply to you. That's an incredibly intense, time and resource intensive process, and as much as it would take enormous amounts of amount of resources from the regulators, but it would also take an enormous amount of resources from the banks, and it would also sort of create a situation where the sort of larger banks that have greater legal spend are going to be in a much stronger position. So anyway, I probably went on much longer than I should have, and I apologize for that. But are there any questions?
Do you have a percentage from about the OTC market? How much which used to be OTC is now somewhere on a central platform?
On a central clearing?
Yeah.
I don't have the percentage. No. I mean, I think that in the U.S. at least, a number of types of sort of interest rate swaps have moved over. But I mean, there is a very large portion. I mean, obviously, interest rate swaps sort of constitute the largest in notional value of the OTC market. They're not the largest in terms of value, certainly. Well, their notional amount is sort of dwarfed by their actual value is much lower. But I don't have a percentage, but I think that I would be surprised if it was a very large number, to be honest with you. I mean, because I think there are a large. Well, I shouldn't say that. I mean, if you're looking at notional amount, I think it probably is a reasonably large number. If you're looking at the swaps market by value, I suspect it's a much smaller number, just because interest rate swaps, you'll have a $1 billion interest rate swap whose value is actually $4,000, just because interest rates don't move that much, So, in terms of notional amount, I imagine there is probably a lot that's moved to central clearing platforms. But at least in the U.S., FX still hasn't moved. Exotics, nothing exotic has moved. The security base, credit default swaps haven't moved. I think that there are a couple sort of index credit default swaps that have moved, but single name credit default swaps have not moved. Interestingly, and single name credit default swaps were part of the thing that led up to the sort of led up to the crisis, right? Because there was a lot of synthetic credit risk there.
May I have another question? Maybe it's
sure.
very short. Maybe the Consumer Protection Bureau, just if you could say, give us one or two examples where you would say that's very important for transparency for the consumers, what they're doing.
Sure. I mean, not sure I have a great answer to that, but I think, the Consumer Financial Protection Bureau, it has centralized a lot of a regulation of the sort of more consumer aspects of the financial protection laws, and in that sense, and they have actually a very helpful website, I have to say. I think that it has, in terms of sort of transparency, I guess that it, in as much as it is a sort of central clearinghouse for collecting information about consumer complaints and possible, financial product mischief or what have you, that's obvious. That obviously definitely helps in terms of transparency. But it has been very controversial, and and there's reason. I mean, it has taken its it's been pretty aggressive about its role. I think most people would probably agree with that. But which isn't to say that it shouldn't have done that, but it has been ambitious in terms of what it's done.
Thank you.
You're welcome.
How would you describe the Financial Choice Act and and how Treasury Board align to each other? And if you see, and the next deliberative question is, what are the reforms you will see two-party will agree upon? What are the party will bipartisanship?
Yeah.
You can find bipartisanship on the reform.
Yeah. So I mean, in terms of the Financial Choice Act. Well, yeah. So in terms of the Financial Choice Act, I think that there are some pieces in there that, in terms of how it aligns with this sucker, there are some pieces in there that align with this. But for instance, Financial Choice says repeal the Volcker Rule outright, and Steve Mnuchin has said no, don't do that. Steve Mnuchin, he has said no. Let's not repeal the Volcker Rule. Yeah, sorry. They diverge in a lot of ways. One thing they actually have in common that I think actually kind of makes sense is they both have said they both would have proposed, or what have you, provisions that would create what's known as an off-ramp from a lot of the enhanced prudential standards. And what the enhanced prudential standards are, Ray, is that basically the idea with this off-ramp is it would say, look, if you have a whole bunch of capital, we're not going to worry about putting you through a stress test or requiring you to submit a living will, because you have a whole bunch of capital and you're going to be fine. You can withstand some pretty heavy losses on your books. The interesting thing about that off-ramp is it wouldn't to my mind, I don't think it would really help a lot of the large banks. I mean, I don't think it's intended to help a lot of the large banks. And the reason for that is that, I think the number is, it requires a 10% leverage ratio, which is, when you think about the business model of a bank, taking deposits and loaning money, or taking in cash and, acting as a liquidity transformer, that's 10%. Holding 10% capital is really a lot of capital. That's one place where they align. There is actually a few brief references to the Financial Choice Act in here. They largely talk past each other, to be honest with you. I don't think that the Treasury Department sort of took the Financial Choice Act as, okay, like here's our basis. What are we going to do? In terms of the two-party bipartisan consensus, I think that there is probably a bipartisan consensus for creating a lot of, providing relief to sort of community and regional banks, because, look, if you're a senator of either party from a state that isn't serviced, that has a lot of small businesses, that doesn't have, sufficient financial services in your state because people can't get loans to buy houses and to start businesses and whatnot. You very much want that to be an option in your community. So I think there probably is pretty good bipartisan consensus around that. I'm trying to think what else. There is also a bipartisan consensus about Title VII, which, to be honest with you, if you would have asked me a year ago, I would have said that would be sort of on people's target list. But for reasons I'm not quite. People aren't touching Title VII. Financial Choice doesn't touch Title VII, and this is the OTC derivative stuff. This doesn't really talk about that. And one thing that I've actually found sort of interesting about that is one area that people talked about maybe 3 or 4 years ago that they don't talk about as much anymore is, one thing with the sort of central clearing is you create these central clearing houses with that really there's really a significant amount of systemic risk built up in those clearing, in a central clearinghouse, right? If the central clearinghouse goes down, a lot of transaction, there's going to be a lot of write-downs at a lot of banks. So, yeah, I mean, I think that that there's certainly bipartisan consensus around that, or at least bipartisan consensus that no one cares, which is entirely possible.
So I think we're going to take a question from our colleagues in Washington, then we'll come back here. Go ahead.
Actually, I have a question about this act also, because the efforts to United States financial regulation seems to lose, can you hear? To lose the attraction. So do you think the Financial Choice Act is a good start, but will lead to the bad result in the future? And the second question is about the Treasury's report on the core principles. On the core principles of the financial regulations, yeah, simplify the capital, the liquidity, and the leverage levels. So do you think this will cause the new risk of the financial risk in the future? Thank you.
Could you, I'm sorry, could you repeat those questions again? There were parts where you were cutting out, and you didn't, sorry.
Okay. The first question is that also about the Financial Choice Act that you mentioned, because the efforts to reform Americans' financial regulations seems to lose traction. So, do you think the Financial Choice Act is a good start, but will lead a bad result in the future? And second question is about the Treasury's report on the core principles of the financial regulations, simplify the liquidity and capital and leverage rules. So do you think this will cause new financial risk in the future? Thank you.
Sure. Okay. So financial choice, whether I think it's sort of a good start and whether, I personally don't agree with everything in financial choice. I think that there are, like I said, there are some aspects of it that I think make sense. As I was saying, I think that as a practical matter, it's not going to become law. I think I would be very surprised if it made its way through the Senate. I mean, it had, as far as I know, it's passed the House. Yes, yeah. I think that it would be very difficult for it to make it through the Senate. I think it would. I'm pretty sure it would require 60 votes too. And to be honest, I don't think there are 50 votes for it. So yeah, I mean that's sort of, in a lot of ways I haven't necessarily gamed out in my head where the Financial Choice Act is going to go, because I don't think it's going to become law. In terms of what is said in the sort of Treasury Department report on the core principles, I think that the thing I guess I would say about the Treasury Department report is that it's certainly not a radical statement of principles. It's not, I mean, the principles themselves are kind of almost unassailable. They're, pretty straightforward. But I don't think that there's nothing in the Treasury report that has sort of stood out to me as that is going to lead to the next financial crisis. But the thing about financial crises is it's always the thing you don't think it's going to be. I mean, bear in mind in 2007, everyone thought the mortgage market in the United States was great. So, or at the beginning of 2007 at least. So, yeah, I mean, in terms of the Treasury report, there's nothing in there that sort of strikes me as radical, which isn't to say I necessarily agree with all of it, but there's nothing in there that strikes me as sort of outside the bounds of sort of reasonable regulation. But the trouble is you never really know what's going to cause the next crisis until it's already happened.
Television, Lebanon. My question is regarding how the outside world, I mean, European banks, or international banks, Japanese, etc., would view such an act. And in the past, they were put under heavy fines for violations of the American regulations, and now they feel that again, you are rescinding on these regulations and changing them. So they definitely will have a say. Do they have any say in this new regulation?
Yeah, I mean, look, the non-U.S. banks are fairly well represented, sort of in terms of lobbying efforts and whatnot. There are, I mean, and if you look at sort of the statistics, and they're actually right at the beginning of this report, foreign banks actually represent a huge amount of the sort of loan base of the United States banking system. When I say huge, it's not I think it's like in the teens, but it's sort of more than it's not like 2 or 3%. So they represent a sort of significant portion of the sort of U.S. loan base, and I in terms of what they sort of view with respect to sort of financial choice or deregulation or sort of the Treasury report or what have you, I think that I think that their interests tend to be kind of aligned with the U.S. banks in large part. I think that there are issues that affect foreign banks more than affect U.S. banks, just because, as you sort of said, you have a lot of foreign banks that don't necessarily, maybe have, there's obviously like foreign banks with very large U.S. operations, but even there are a number of foreign banks that have sort of mid-size or small U.S. operations, and they still find themselves sort of subject to a lot of the sort of U.S. banking law overlay, and even on a sort of global basis. I mean, I think every sort of banking lawyer in New York has done a lot of work for foreign banks in Europe or in Asia who are just sort of saying, what is going on with the Volcker rule? And but in general, I think their interests are probably largely aligned with the U.S. banks. I mean, they diverge in places because I think that the foreign banks generally would like to say, okay, why don't you just look at our U.S. business and sort of not touch the rest of the world? But yeah, so I think that that's probably that. Any other questions?
Could you elaborate that whether the U.S. financial system is stable enough for the Trump administration to repeal the Dodd-Frank?
Probably not. No, I mean, I guess what I would say to that is Dodd-Frank isn't going to be repealed. I mean, I would be very, very surprised if financial choice. I don't even think it's going to be brought to a vote in the Senate. Honestly, I don't know, but I would be surprised if it even got brought to a vote in it. I don't think that it's going to go through. And I mean, to be fair, financial choice doesn't repeal all of Dodd-Frank. It makes, in most places, sort of makes tweaks more than it actually does a repeal. But in terms of the sort of broader financial system, I mean, I think that it's certainly better than it was in 2010. I'm not an economist, so I wouldn't want to sort of speak to that in a quantified way.
Okay. So, is there any difficulties that the administration will face in repealing that Dodd-Frank?
Are there any things that it would fix? I mean, it's some of the points that I think I raised earlier. Like I said, one of the sort of things that I mean, again, I'm not an economist, but I think that I've read economists say is holding back the U.S. economy is that there's a glut of credit available at the top of the market for large businesses, but the sort of small and medium-sized businesses really do have trouble. And I mean, and I think that the sort of reform I was talking about, where we sort of maybe take the foot off the brake a little bit in terms of the community and regional banks, that could help that. I mean, it would also help. I mean, the larger banks tend to lend in larger amounts, but obviously they do small and medium-sized business lending as well through their branch network and whatnot. But yeah, I mean, I think again, I think that there are aspects of Dodd-Frank that I don't know anyone who doesn't really think this, at least somewhat, that there are aspects of Dodd-Frank that could probably be scaled back that could help the economy grow. I don't think we're going to get a full repeal.
The same topic, is there any, you suggest any data that really illustrates, say, per entity lending to the small borrowers or not? Really? I was looking for that data, but I didn't really show
Yeah, I mean, sorry. Let's go looking.
56 or something.
Yeah, I mean, there is some data in here. The Federal Reserve actually compiles a lot of data, especially the Federal Reserve Bank of New York, which is, like a slightly different entity, but they tend to have a lot of data on a lot of economic data. Each of the Federal Reserve banks in the various districts, which were on that map with the Federal Reserve, each of the districts, they compile something. I think it's called the Beige Book, which sort of summarizes economic conditions in their district. So that has a lot of raw data in terms of that you can ask an economist about.
Just a very basic question on the Volcker Rule and the separation between banking activity and or sort of the retail banking activity and proprietary lending. Bank of America is a big global investment bank, but it's also has retail banks. Are they just completely separate companies that are sharing?
So the way this sort of structure of large U.S. banks is it's a pretty complicated question, and it actually differs a lot than the way it works in, frankly, most other countries. So the point. Let's see if I can pull it up here. Sorry. One of the points here is about. So in 1933, the Glass-Steagall Act was passed, which basically said commercial. Oh, sorry, it is 14. The Glass-Steagall Act was passed, and basically what the Glass-Steagall Act said was, you, J.P. Morgan, because J.P. Morgan was an active bank at the time. You, J.P. Morgan, the deposit-taking entity cannot be affiliated with a securities business, right? And that actually, the reason that Morgan Stanley is because it had to spin off of J.P. Morgan after Glass-Steagall was passed, right? The breakup of the House of Morgan, as it's known. So that was the sort of first, this idea of banking versus commerce had existed in U.S. law for a very long time. But the idea that in addition to the bank not doing non-banking things, that the bank's affiliates wouldn't be able to, was fairly new in 1933. Then the Bank Holding Company Act in 1956 said, in addition, bank and the entire broader range of affiliates and the broader organization cannot engage in anything that is non-banking. I mean, obviously, we have sort of retrenched from that. In 1999, the Gramm-Leach-Bliley Act passed, and it basically said, actually, Bank of America, J.P. Morgan, you can have a securities business and you can have an insurance business, but you still can't open a hot dog stand. So the sort of law, even in the sort of pre-Dodd-Frank, pre-Volcker Rule world, was very much that you can have, a commercial bank, commercial deposit-taking bank, can be affiliated with a securities business, can be affiliated with an insurance business, but it can't. Whatever it does has to be. Phrase of the statute is financial in nature, and that actually captures a lot, and it actually can capture certain what are known as merchant banking investments in sort of basically it's like private equity investments, right? But it has impacted. But the result of that, right, is that in a way you're right. Like the deposit-taking bank of Bank of America N.A. It can take deposits. And it can make loans. The list of things that it can do is pretty limited. The list of things that the broader Bank of America organization can do is also limited, but a little bit longer. But like Bank of America N.A., you'll never open a securities brokerage account at Bank of America N.A. because it can't do it. So.
Then how this is different from conglomerate companies like GE, which also manufacturing companies and also have a lot of financial.
So, GE is, it's actually spun off GECC, right? Yeah. But in the it didn't have a deposit-taking bank. It had what is known as a thrift. And a thrift holding company doesn't have the same sort of hang-ups. I shouldn't call it. That was the wrong word to use. It doesn't have the same sort of limitations as a bank holding company does.
So please a little bit about the future of the reform of the financial regulation, and also just predict maybe next step of the Trump administration.
Yeah, I think that we will see some guidance on Volcker. In fact, I think there's actually been press reports that that there's the OCC has been talking about how it's going to release what's known as an advance notice of proposed rulemaking, which is broadly just a sort of statement that we're thinking about, here are some things we're thinking about with respect to this topic. They don't always become regulations. In fact, most of the time they don't. But I think that, the OCC, I think they're going to release it potentially even this week. That will provide, I think, some daylight on where the administration is sort of heading on Volcker. I mean, to be fair, it's less the administration than the people as policy idea, the people who he's appointed. But I think that there's a reasonably good chance we could see some legislation around the sort of community bank, regional bank issue. The Congress's calendar is very busy, and it's kind of not legislating a whole lot right now, so getting floor time in the Senate, the Senate's only open X number of days a year, and you have to find time to talk about this legislation for however many hours you have to talk about it for. So I guess I wouldn't be surprised if we saw legislation along those lines. I wouldn't be surprised if we don't, just because there is a sense in which people run out of time. I mean, Congress also has a budget and raise the debt ceiling and things like that.
Sort of geo inequality. I mean, wealth disparity amongst the region has been under political spotlight for a year or so. West Virginia versus rich areas. Do you think Dodd-Frank had plays a role to aggravate that disparity, or it's a fair call to say that?
Yeah.
Given the conversation we just held.
Yeah. I mean, again, I think that's probably an economist question that I can't quite answer. I mean, I guess the one thing I would say is that in as much as there are parts of the United States that are what we would call underbanked, right? I mean, in the sense that there are consumers that don't have access to the amount of sort of banking services that they need. I'm not. Yes, ask the economist that question. But there are. I mean, it's sort of recognized that there are parts of the United States that are underbanked. And, when you think about that, that's bizarre, right? I mean, we literally have thousands of banks in the United States. And it's weird that the United States would then be underbanked. Or there would be parts of the United States that are underbanked. And, the thing about regulation, right, is that, any industry of any kind of, it costs money to comply with it. And larger institutions find it easier to absorb those costs than smaller institutions. And smaller institutions are more likely to provide banking services to underbanked regions. Typically, I mean, that might require a little bit of a leap of faith, but I think that is probably true. You've also seen, with a number of sort of large banks, a shift toward doing more asset management work. And that, I think, is a result partially of Volcker, partially of sort of new capital rules. But, the shift toward asset management work, I mean, look, the truth is that, if you're if you're a middle income or sort of a low income person, you don't need help finding a hedge fund to put all your money in, right? You need help. You need to have a savings account that pays interest. So yeah, and one other thing that's actually kind of interesting, right, is that the interest rates have been historically low, right? They've been very low, and there's good reason that they were low, but one of the consequences of really low interest rates is really, really low returns on savings. And again, that that has a tendency to disparately impact low-income people, because low-income people are more likely to keep their money in a savings account rather than a sort of upper-income person who's like, oh, well, I'll just go buy shares of Apple or whatever. You know, I mean, they're not going to have access to the broader array of sort of financial services.
I think we're going to have time for one more question, and then maybe he can take a question after this, but that way, in case someone has to leave, we'll take one more question and then...
Okay, great.
How about two?
Well, we have three.
We'll take one.
Okay.
3 more questions, okay.
Do you want to go?
Oh, okay. So, regarding to vocal role, actually, during an interview today, Goldman CEO Blake Finn actually he said in an interview that vocal role is cumbersome and makes trader nervous because of the blurry line between speculation and market making. So, could you elaborate more on the challenge to clarify between speculation and market making?
Sure, of course. And I mean, I think, I'm sure Lloyd Blankfein is waiting to hear what I have to say about this, but I agree with him. And I mean, the word cumbersome is a little bit weird, but look, the broad prohibition on the vocal rule, right, is don't proprietary trade. However, there's an exception that says you can make a market. If you're talking about securities and certain types of derivatives and, certain types of financial instruments, it's very clear what, like a New York Stock Exchange specialist, right? He's a market maker. You know what he's doing. He knows he can rely on the market making exception because it's real easy. That's not going to be too cumbersome or complicated. It's when you get down to instruments like corporate bonds and more exotic derivatives and asset-backed securities and sort of anything for which there isn't a sort of open and liquid market. That's when you're going to have. That's when the market making exception becomes really complicated, because in a lot of ways part of the market making exception turns actually on the trader's intent. Is the trader intending to make money on the short term, on holding a short term position in this asset, or is it just trying to service its clients? If it's just trying to make money on the short term, that's a problem. If it's just trying to service its clients' interests, that's not. The thing is if I'm a trader on a desk and I'm making market in corporate bonds, and I think, okay, well, I know that this fund that is one of my clients, I know that they typically they mention that they might be interested in, there's typically a demand for this X bond, so I'm going to go buy some of those. And let's suppose you hold those and the market moves, the interest rates go up, the interest rates go down, and all of a sudden that bond that has a pretty high coupon, it actually is worth a lot more. And then it turns out that, no, your clients don't want it, so you sell it on the market. I mean, I would argue what you did was within the bounds of the market making exception. But I think that's exactly what he's talking about, because the issue is, it's hard to demonstrate that with objective evidence, that what this person was doing was really trying to service clients. So yeah, I mean, I think that does that answer your question?
Yes.
Okay, so yeah, I mean, sort of is the best I can do.
Sorry, I forgot to identify myself earlier. I'm Robert Delaney with the South China Morning Post.
Okay.
So we look a lot at the investments, large-scale investments coming in from China to the U.S. So I wanted to get an idea of, to what extent does the regulatory framework, or any part of the regulatory framework that you're talking about, ever get involved with looking at or reviewing large amounts of capital that are coming into the U.S.? Or is that strictly like a CFIUS?
Well, in terms of the non-financial sector, so in the non-financial sector, the banking, the financial regulators won't typically be that will typically just be a CFIUS thing. Right. The one thing I would say about it is, you can imagine a scenario where you'd have a buildup of risk, and FSOC might be concerned about it, but that would be a pretty exotic scenario. So, I mean, yeah, the answer is that's probably more of a CFIUS thing. I mean, obviously, if you're talking about capital coming in to acquire U.S. banks or bank holding companies, that's a different bag. This is a different bag of worms altogether. But yeah, I think I messed up that metaphor. But anyway.
Going back again to the earlier conversation on compliance costs, it reminds me of the conversation we had when we had SOX and subsequent 404 rules, and people were complaining that small cap cannot comply with it. Eventually, I think there were a lot of exceptions, but on this topic, at that time, I remember there was a public outcry,
Mm-hmm.
and now I think it's although they're not listed companies, perhaps I don't see a lot of public repercussions, complaining that a smaller company not it's not well funded. It's kind of disproportionate, from what I experienced covering that SOX and 404 15 years ago. And why it's only a part of the Treasury report these days?
Why isn't there a greater outcry?
Why how come New York Times is not covering intensively? Why is that?
I can't speak for the New York Times. I think that there are a couple of things. There isn't a ton of sympathy for the financial sector. There is not a ton of sympathy for the financial sector. So there's that. And I think, and I also think that there's a sense in which I think there's a sense in which, a lack of sort of availability of banking services is an easy thing to miss, right? I mean, it's and to be fair, I actually have seen a New York Times article about this, but it is an easy thing to miss. It's not, I don't think there are many reporters based in New York and Washington D.C. that are sort of out there pounding the pavement trying to find out more about, is everyone in Wyoming getting access to banks? That's not a beat. So I guess, whereas you can sort of imagine, and I guess the distinction between the SOX situation was that the SOX situation you had sort of bread and butter companies. It was impacting bread and butter companies, the commerce companies rather than finance companies. So yeah, I mean, I think that's probably it. I suspect that's probably an incomplete answer, but I think that's probably all I got.
All right, thank you so much.
Thank you.
Thank you all for coming. Thank you, Dr. Lackey.